Hey guys, I'm Matt. In this video, I'm going to walk through my analysis of Home Depot, the home improvement department store, ticker symbol HD. On this channel, my goal is to log my journey to financial freedom by sharing my portfolio and showing how I'm doing this through disciplined saving and smart investing. Now let's dive into Home Depot. Home Depot is a company with great marketing. It helps doers get more done. And it's a retailer that basically sells you everything you could possibly need when it comes to your home, whether you're building one, repairing, doing any renovations, or having any home improvement project. And if we look at a pie chart of Home Depot's revenue by each of these segments, we can see that not only does Home Depot have a lot of segments, but it's pretty well diversified over all these segments. Its largest revenue driver is going to be its indoor gardening, which comes in at about 10%. Right behind it was electrical and lighting, which came in at 8.9%, and appliances also at 8.9%. So Home Depot is very well diversified over all of its different segments, and it's not too reliant on any one of these categories to perform well. Home Depot has just under 2,300 stores, and they're located all throughout North America. If we look at a chart to see where these stores are located, about 87% are located in the USA, about 182 stores are in Canada, which is about 8% of Home Depot stores, and 125 stores are in Mexico, which is just 5% of Home Depot stores. Also at the bottom, I have Home Depot's store growth over the last 6 years. In 2015, Home Depot had 2,274 stores, and we can see that Home Depot hasn't been expanding a crazy amount when it comes to its store count. This is something that the management team has said, and in 2015, 2016, the management said that because the retail environment is changing with the shift to online, that they're really going to be focusing on improving the store experience and changing with how the retail environment is changing. And we'll see how Home Depot has been doing with that later in this video. As we look into the numbers for Home Depot, it's going to be good for us to compare them to its purest competitor, Lowe's. This is because they sell very similar products. However, even though they both sell the same products, their business models are very different because they both target different customers in this space. And in the home improvement space, there's really two different types of customers. You have the DIY homeowners who are doing home projects on their own, and you have the professionals. The professionals are going to be the people who do this for a living, which are going to be your contractors, renovators, general handyman, real estate developers, and tradesmen like painters, plumbers, and electricians. And Home Depot as a company really focuses on targeting to the professionals, while Lowe's, on the other hand, really likes to try to target the DIY homeowner who's doing a home project. And while Home Depot and Lowe's will definitely help both types of these customers, as you read in more into the annual filings or the management discussions and the 10K reports, each of these companies definitely tends to gear towards attracting one of these types of customers. So let's see how Lowe's and Home Depot stack up to each other, starting with total revenue. So despite Home Depot and Lowe's actually having a pretty similar amount of stores, Home Depot has about 10% more probably throughout these 6 years. In 2015, Home Depot did a whopping $83 billion in revenue compared to Lowe's $59 billion, and both have experienced pretty good growth throughout the last 6 years. But in 2020, Home Depot did $132 billion in revenue compared to Lowe's $89.5 billion. So Home Depot not only does more revenue, but if we look at its growth over the last 6 years, Home Depot has been growing faster. Home Depot grew from 2015 to 2020 at about an 8% rate compared to Lowe's 7.2% rate, which you would actually expect if Lowe's had a smaller amount of revenue and a good business practice or comparable business strategy, that it would be able to grow just as fast or faster. So definitely when it comes to just looking at top line revenue, it looks like Home Depot is the winner here. Now if we go to gross margins, the first thing that stands out to me is Home Depot has been very consistent with its gross margins. I mean, in 2015, its gross margin was 34.2%. In 2020, it was 34%, and in 2019, it was 34.1%. Very, very consistent. Home Depot's average is about 34.1%, while if we compare to Lowe's started out in 2015 at 34.8%, And then in 2017, it dropped to 32.7. In 2018, it dropped to 32.1. And then we got a pop in 2020. You know, a drop from 34 to 32% might not sound like a big deal, but it's important to remember with retailers that their net margins are actually pretty small, and most of them are around 5%. So if you lose 2% in gross margin and you drop from, or even you just lose 1%, you go from 5% to 4%, that's a 20% drop in your net income margin. So the consistency and better gross margins in Home Depot is definitely something that makes it more attractive than Lowe's, I would say. So gross margins, also, it looks like Home Depot is the winner here. Now moving on, whenever you're looking at any retailer, one of the most important metrics that people like to keep track of are its comparable sales or comps. If we look at comps between Home Depot and Lowe's, from 2015 to 2019, Home Depot is actually doing much better than Lowe's. 2015, 5.6% compared to 4.8%. 2016, 5.6% compared to 4.2%. That's an even bigger switch. Let's see, in 2017, Lowe's beat Home Depot by about 0.5%, 4% compared to 3.5%. But in 2018, Home Depot beat Lowe's by 3%. Definitely a bad quarter for Lowe's there, or a bad year. And then in 2019, Home Depot beat Lowe's again, 3.5% compared to 2.6%. However, in 2020, Lowe's did very good because both Home Depot and Lowe's were able to stay open during quarantine, and a ton of people, as they were trapped in their homes, wanted to work on home improvement projects, and so Lowe's was definitely the winner during COVID. And if we look at its average comps over the last 6 years, they come out pretty similar. Home Depot's 7.2% compared to Lowe's 7.3%. Home Depot's performance from 2015 to 2019 being pretty consistent, but Lowe's came out on top if we include 2020. So I'm gonna say when you look at comps that on a whole, it's about a tie. So this is sales per square foot. This is the most important metric that you can look at for any retailer, especially when comparing retailers that perform similar jobs, because it helps you see which retailer is more efficient at driving top line growth with the same amount of real estate. As you dig into these numbers, it's really clear that Home Depot is a very efficient operator, and this really shows in its sales per square foot. In 2015, Home Depot's average sales per square foot was $371, while Lowe's was $292. And now in 2020, Home Depot's sales per square foot was $544 compared to Lowe's $436, which is, this is a really big discrepancy, because basically for every square foot between the two stores, if you look at Lowe's, Home Depot is going to do more than 20% more revenue for every square foot, which gives it a pretty big advantage when it comes to profitability. And this is a chart that really speaks for itself. Home Depot is the clear winner here. So all the metrics that we've looked at so far have really revolved around the top line, revenue growth, and general operating, how efficiently each company operates. It's pretty clear that Home Depot is the much more efficient operator. So now let's see how this translates into the bottom line in terms of profits. So this is a chart that shows each company's net income and net income margin. So first, if we look at net income margin, Home Depot has always had a better net income margin than Lowe's because it's just a more efficient operator. And this, as you look at the net income as well, you can see how this translates to generating a lot more profits over a 6-year period. So in 2015, Home Depot made about $7 billion in net income compared to Lowe's $2.5 billion. And in 2020, Home Depot has a net income of about $12.8 billion compared to Lowe's $5.8. And if we look at its growth from 2015 to 2020, Home Depot has been growing its bottom line by just under 10%, 9.9% compared to Lowe's 6.5%. So this is really good. This is very impressive for a company of Home Depot's size. And this really highlights that the management team has been doing a very good job on executing on its strategy, because Home Depot has not been expanding its store count nearly as much as Lowe's over this period. It's been able to do better on revenue growth, net income, and net income growth than Lowe's. So I would say that the business strategy that the management team at Home Depot has put in place has been very good and very profitable for shareholders of Home Depot. And another important metric that both companies judge itself by is going to be its return on invested capital. This is basically taking the net income that each company generates and dividing it by its total invested capital, which is going to be its total debt and equity. And if we look at the performance of return on invested capital from 2015 to 2019, not only was Home Depot's larger than Lowe's in 2015, 28% compared to 14%, but Home Depot has been doing a much better job at growing its return on invested capital, because in 2019, Home Depot's return on invested capital is 45% compared to Lowe's 20%. So this is very impressive for Home Depot, and Home Depot is the winner when it comes to this metric as well. So after going through a lot of its fundamentals that we can get and metrics from the income statement, it's easy to see that Home Depot is a very efficient operator. But now it's important for us to look at the balance sheet of Home Depot to get an idea of its assets and its liabilities. One of the first things that I always like to do when looking at a company's balance sheet is to look at its current assets compared to its current liabilities. It looks like Home Depot is doing good here. Its total current assets is $28.4 billion compared to its total current liabilities of $23.1. So no problem in being able to pay any of these short-term obligations or liabilities. When looking closer at its total current assets, we see that it has about $16.6 billion in inventory. But so when looking at inventory and current assets, it's always good to look at the inventory turnover ratio. The way we calculate this is we basically take the company's cost of goods or cost of sales and we divide it by inventory, because this gives us how many times is Home Depot expected to sell $16.6 billion of inventory throughout the year. So from the income statement, I'm taking its cost of sales of $87.2 billion and dividing it by 16.6, and that comes to about 5.25, which is very good. And we have to remember too that Home Depot has a gross profit of about 30%. So if it sells roughly 5 times that $16 billion throughout the year, each time it sells that $16 billion, it's going to collect an extra $5 billion, or just a little over that, because it's about a third of $16 billion. So there's really no problems when it comes to Home Depot, when it comes to looking at its assets versus its obligations, at least in the short term. Now, if we switch to look at its total assets versus its total liabilities, we can see that Home Depot has a total assets of $70.58 billion versus its total liabilities of $67.2 billion. In its total liabilities category, it has long-term debt of $35.8 billion and also long-term operating lease liabilities of $5.3 billion. Those are both considered debt when it comes to accounting. So Home Depot does have a lot of debt, and it has a debt to asset ratio of 0.6. But however, this shouldn't be concerning to investors, because Home Depot is a very efficient and very profitable operator. So this isn't very concerning when you look at it from that standpoint. So finally, if we look at Home Depot's equity of $3.3 billion, this is not a lot for Home Depot being such a profitable company over the last 6 years. And the reason for this is Home Depot has been doing a very good job of returning that capital to its shareholders in the form of buybacks and dividends, and also reinvesting or investing in other companies, acquiring other companies to try to grow its top line as well, which Home Depot did just buy HD Supply, and it just announced it in one of its last quarterly reports. So this is the reason why its equity is not very high, which isn't a problem, because investors in Home Depot are really looking for cash flow, for Home Depot to increase its cash flow or return capital to its shareholders. Nobody is really valuing Home Depot by its book value or its equity that it's holding on its balance sheet, nor should they. So if we look at how Home Depot has been returning capital to its shareholders through its dividends, Home Depot currently has a dividend of $6.60 a share. This comes out to a yield of about 2.5% at the time I'm making this video. And Home Depot should definitely be a stock if you're interested in a company that has a very strong history of growing its dividends and is showing signs of continuing that strong performance into the future. And even though the 2.5% yield might not sound too appealing, when looking at a dividend stock to invest in, it's really important to look at its dividend growth history and its potential to grow its earnings in the future, so it has the potential to keep growing its dividend. And as you get these 10, 15, 20% dividend increases each year, you'll be shocked at how much money you'll be able to get from dividends if you stay invested in these very good, efficient companies. So on the screen, I'm going to put a chart that shows Home Depot's dividends from 2016 to 21, as well as its shares, which we can get at stock buyback from. So in 2016, Home Depot had a dividend of $2.76, and as you can see, from 2016 to 2021, it had some really good quarters where it increased. In 2017, it increased its dividend by 29%, in 2018, 16%, and 2019, 32%. So those were, very good quarters for dividend increases. And in 2020 and 2021, it only increased its dividend by 10%. And from its recent announcement, we can see that the reason they did this is because they were trying to get more cash so they could acquire HD Supply, which they did. And this dividend growth from 2016 to 2021 comes out to about 15%, which is phenomenal. So I'm always very excited to grow in companies that are able to grow their dividend by more than 12% every year. And on the other side, if we look at Home Depot's outstanding shares, we're able to get its buyback, how much stock that it bought back. In 2016, Home Depot had about 1.2 billion outstanding shares, and in 2021, it's now just at about 1.07 billion outstanding shares. So it's been buying back 3 to 4% of its outstanding shares every single year from 2016 to 2020 and 2021. Again, they're trying to stock up some cash to make an acquisition, but on average, their average buyback yield from 2016 to 2021 was 3.2%, which is very good when also you look at its dividend yield as well. It's clear I like Home Depot and I am an owner of the stock. I am going to be sharing my positions after this next segment. But I really in this segment, I wanted to give a summary of the reasons on why I really own Home Depot, just a general summary of it, and why I think it's a good long-term holding, just from a strategic point of view. The first reason is not only do they have a really good management team, but they've been doing a very good job on executing on its strategy of integrating its e-commerce with its physical stores. And this has been a really big driver for improving its revenue and sales per store, while also help improving its bottom line by better utilizing its overhead and the real estate that it owns, which I think has just been a really good strategy for Home Depot. And I think they're going to continue to improve this going forward. The second is that Home Depot has a proven history that they really do understand their customers. The professionals, they're very loyal to Home Depot. Home Depot is always looking for ways to improve this customer experience, and I think they're going to continue to do that going forward. The third reason is, which nobody should be surprised, but the housing market is very hot right now, and I do think that real estate developers are going to be very busy in these next coming years because there is a supply shortage in the housing market for sure. The home builders are going to do very good over the next 5 years, and I don't think this housing supply shortage is going to be something that's going to be fixed very quickly. I think it's going to take a couple years in order for the supply-demand to start to even out. The fourth reason is that Home Depot is also going to benefit from the demographic trends that the United States is having right now. Currently, every year, there are more people entering the 30 to 50-year-old range than there are leaving. So this is really important because this is the millennial demographic. As millennials are getting into that age range between 30 and 50, they are entering into the housing market. And just by pure demographics, there's going to be more people in that range looking for homes. And this is going to continue pushing increased demand for homes and housing over potentially the next 5 to 10 years. And so this is a really good tailwind to be behind a company that you want to own for long term. And another reason why I think Home Depot is going to do well long term is taking into account the average age of the US home. The average age of a home in the US is around 40 years old, depending on which site you're looking at. Some say it's 35, some say it's 45, but let's just say it's 40. As homes get older, not only do they require more repairs just around the house to keep them functioning, but also when people buy older homes, the aesthetic, especially for people, younger people entering the housing market, they're going to buy, if they buy a home that's over 40 years old, they're definitely going to want to make a lot of renovations or at least some small changes to the home just to update it so the house is going to look more modern. I mean, how many times do you watch a fixer-upper show on TV where, you have a couple buy a home that has just a completely old school closed layout and everybody wants an open layout now? And the only way to do that is going to be using a home improvement store like Home Depot or Lowe's. And I think this is another positive tailwind for this company going into the future. But also, one tailwind that I wanted to highlight is that people are always going to bring up that increasing rates for the housing market is going to be bad. And that is true. It does have an effect that as rates rise, people's money goes less far when it comes to buying a home because their mortgage payments are going to be more expensive. However, I think that the demographics and the current housing shortage are just usually much bigger factors. And when you look at interest rates over the past 10, 15 years, they're still very, very low. Nobody is not buying a house right now because interest rates are too high. So yes, increasing rates is a risk, but it's not really an immediate risk, and it's not one, worth concerning ourselves about right at this moment. Although down the line, it could be more of a problem. And these are really the key points that summarize, why I think Home Depot is a good long-term hold. Now let's get into my position. All right, so this is a chart of my positions. I share when I bought, how much I bought, and what's my cost basis, and basically what is my current gain and loss on this stock right now. So I started acquiring Home Depot in August 2017, which seems like such a long time ago. I actually distinctly remember buying Home Depot because it pulled back to $150 a share. And I remember at that time it had a PE of about 22 as well. So, even though it doesn't seem like I'm getting a super great deal at a price to earnings of 22, it's important to remember that you want to buy companies that have reasonable expectations going forward. So because Home Depot has been doing a really good job at improving its net margin and also growing a lot faster than people were expecting, my position is up about 87% just off of Home Depot. I also purchased a little bit in March, right before the kind of the beginning of the COVID crash. I got in at about $220 a share. It was a bumpy ride going through COVID, but Home Depot is a company I have a lot of conviction in, so I wasn't really worried, and it wasn't a position that I wanted to exit out of during COVID because especially, when it crashed, Home Depot was one of the few companies that remained open. And, I just knew that it was going to rebound and that I was going to do well. So that position is up about 26%. And I also recently just purchased some positions in late February. I just purchased 3 stocks at about $258 a share. Yeah, whenever I see Home Depot get close to the 22, 23 PE range and the chart looks good, it's always a company I'm interested in adding. I was actually kind of hoping Home Depot was going to sell off more, but after I bought it kind of bounced back pretty quick. So I might wait for another pullback. But moving on, I included my dividend reinvestments into Home Depot, so I have my accurate cost basis. I've acquired about 1.33 shares just from reinvesting dividends that I get from the company. So this comes out, my total cost basis is just under $5,000, $4,955, and that's about $188 a share. The current price is $282, and so that means my total gain is about 50%, or about $2,472. So this is a chart of Home Depot from 2020 to now, basically the beginning of 2020 to now. So Home Depot had a much quicker recovery than most other stocks. Home Depot from March to August basically doubled and went from basically $150 to $290, just under $300. It had this really big run up, and since then it's been digesting its valuation. It's gotten to the point now where it's consolidated at this price range long enough where its PE is starting to get appealing. And when it dipped below its moving averages, that's when I kind of got really excited and I wanted to start buying. And I was curious to see if Home Depot was going to sell off even more because anything below a 22 PE of Home Depot, I'm really excited to add. But it popped back really quick, and it's been in this channel. It's been consolidating for since August. So I'm curious to see if Home Depot is going to break out of this channel. If it does and it retests the top line of that channel, I might be adding again to my position. Or if this top end of this channel continues to serve as resistance and it's not ready to break out of this bull flag pattern, then I'm also going to be buying at the bottom end of this channel as well. So this is a company I'm interested in how it's doing over the next couple months because I think its valuation is good. Its prospects for growing its earnings is good. It's a very efficient operator, and it's just a good company that I want to add more to my portfolio. I hope you found my analysis of Home Depot useful and enjoyable. If you're a dividend investor and you're looking for another stock I've done an analysis on, I just did a video on Allstate, and at this time, Allstate just raised its last dividend by 50%. So definitely check that video out. Insurance companies are generally very overlooked and they have a very good business model. So definitely check that one out if you're a dividend investor. I'm also going to be posting a link to a video I did on Splunk, which is a growth company that I really, really like, and it's sold off a lot over the last couple months. So if you're more interested in growth, check that one out. Everybody, this is Market Matt, and have good luck investing.